All three banks announced their results. In this video, we will go through the unique differences in the performance between DBS and the other two Singapore banks, which are UOB and OCBC, and how DBS are actually outperforming them. This can also be seen from their share prices, where UOB and OCBC experienced a short drop in their share prices, while DBS actually held and even went up. For those who are not so familiar with banks are dependent on two main incomes. One is the interest income, while the other is the non-interest income. Interest incomes are income earned from the interest of debts, which are essentially the difference they make using the customer deposits. Non-interest incomes are the rest of the income of the businesses, such as credit card fees, wealth management fees, or trading and investment incomes. Now let's go on to UOB's earnings. If we see their earnings summary, it's not so good, with both net interest income and non-interest income decreasing. Fees and trading income, which is the large portion of the non-interest income, decreased quarter over quarter, which is disappointing, while net interest margin also decreased, which was expected. With the interest rate dropping, net interest margins for banks will be expected to continue dropping. How they offset this drop is through the increase in the amount of customer deposits that they hope to attract, and to increase the amount of loans that they give out. However, for this quarter, net interest margin has a large drop of 0.09% quarter over quarter. This is one of the main reasons why their net interest income dropped, resulting in a lower net profit of 10% lower. Fee income also came in lower at 8%. Non-performing loans is still quite decent at 1.6%, while UOB still have plenty of cash with CET1 ratio of 15.3%. We can see from their balance sheet where they elaborate more on the results. Because of both drop in the interest and non-interest income, this resulted in a 10% drop quarter over quarter. Unfortunately, with lower profit, this meant that dividends declared will definitely be lower because banks tend to pay based on 50 to 70% of their profit. Looking at the breakdowns of the interest income, we can see that their loan margins and net interest margin has dropped significantly. What this tells us, as interest rates are expected to be cut, loans will become cheaper, therefore banks will earn lesser. Therefore, in order to reduce the drop, banks will cut the interest paid to high interest savings account. I will not be surprised to start seeing banks cut more on the interest for savings accounts as interest rate starts coming down. Although assets increase slightly, this could not offset in the drop in the interest, therefore resulting in lower interest income. We can see from this slide that most of the drop was due to asset repricing. This usually occurs as banks are in the process of securing new loans at a lower rate. This resulted in a large drop thanks to Hong Kong and Singapore drop in interest. Fee income came in lower but is still up 11% year over year. However, it was not enough to offset the drop in the interest income. Cost to income ratio is an important parameter as it is a way to show the cost efficiency of the bank. With lower income dropping larger than the drop in the expenses, the cost to income ratio increased as expected. For bank allowance, it's essential for banks to set aside an amount for those debts or loans that they deem to be risky of defaulting. It's good that it's not increasing, as lesser allowance might also mean that there are lesser bad loans around. Loan growth is quite disappointing with just 4% higher year over year. This is one of the reasons why their interest income dropped. Like I mentioned previously, the way banks can offset the drop in the margin is by having more loans being given out. Hopefully, as loans get cheaper, it will attract more people to take on loans, therefore benefiting the banks. On the bright side, even with the drop in the income and dividends given, UOB still have a lot of cash with CET1 ratio of 15.3%. Therefore, with lower profit and income, their dividends come in lower at 85 cents, which was disappointing. With their forecast to have net interest margin dropping to 1.85% to 1.9%, I would expect their full year income and dividend for this financial year to be slightly lower. Therefore, with the dividends dropping, if we include the bonus dividends of 50 cents this year, their current dividend yield at the share price will be around 6%. Honestly, it's still not as bad, but we should expect their dividends to either maintain or drop in the coming years due to lowering interest rates. If you find this video enjoyable so far, please support the channel by hitting the like and subscribe. Thank you, and let's go on to the next bank, which is OCBC. In recent times, there was big change with CEO Helen Wong retiring. Funny thing is that the share price actually went up after the CEO was changed, so the market must be happy. Looking at the key highlights results, it does not look that good at the first glance. Net profit was down 6% year over year, while total income decreased by 1%. Non-interest income continues to remain strong at 8%, while net interest income dropped 5%. It's important for all the three banks that with the interest rate coming down, their non-interest income needs to increase in order to sustain their dividend payout. Naturally, with lower income, their ROE has dropped, which is this case by negative 1.9%. Net interest margin continues to drop from last quarter from 2.04% to 1.98%. Thanks to the good customer loans and deposit growth, it helps to offset some of the drop in the margin. With their net interest income dropping, it's impressive to see that their non-interest income continues to remain strong when comparing the first half of 2025 to first half of 2024. This might be one of the reasons why their share price didn't drop much, as this shows that the bank might be more resilient than expected. With the operating expenses and allowance increasing, this led to a lower net profit of 6% year over year. Although net profit and net income dropped, customer loans and customer deposits are growing strongly. Moreover, in recent months, OCBC had made interest cuts to their OCBC 360 accounts, which is their high-yield savings account. This will definitely benefit shareholders as they should expect to earn slightly higher margins from their customer deposits. Wealth management continues to impress with 4% year over year, while banking is up 11%. However, quarter over quarter is only up 1%, so hopefully we can see more inflows in the subsequent quarters, as this will be very important for the bank. Great Eastern continues to perform fantastic with 10% income higher and higher margin of 44.7%. Net interest margin continues to drop to 1.92%, but honestly, it's surprising that it's dropping so quickly. This will mean that the loans that are starting to get a lot cheaper, and we should see savings interest accounts continue to drop in the near future. We can see that, similar to UOB, Singapore and Hong Kong benchmark fell by more than 0.5% and 2% respectively. So most of the impacts is actually coming from these two loans. However, what I like is that they are deploying more liquidity to high quality assets, which is good to see. For non-interest income, although this quarter is slightly lower than last quarter, it's still up year over year. Moreover, net fees and commission fees, which are the more stable non-interest income, continues to perform strongly. If we see the breakdown of their fee commission income for this quarter, wealth management and other fees are the ones that is helping OCBC with the non-interest income. Honestly, for OCBC's wealth management, it's impressive because even quarter over quarter, it comes in higher. Year over year wise, it's up 25%, and we should continue see it increase as more customers deploy more funds into investing. For their operating expenses, it's good to see that it comes in lower. With lower income, lower expenses will definitely help. Moreover, with the implementation of AI, hopefully we can see more efficient operation and decrease in the operating costs. OCBC non-performing loan is the lowest of the three banks at 0.9%, but it's not a big factor as long as there's no sharp increases. One thing to highlight from their allowance is that surprisingly, the allowance dropped quarter over quarter, which is good as this meant that lesser amount of loans are deemed to be at risk. After dividend payout, their CET1 ratio will be at 16.2%, which is still much higher than the average required safe ratio of 10%. Similar to UOB, with lower profit and the same dividend payout ratio, this will mean lower dividends, as we can see that for the first half of 2025 is at 41 cents compared to last year of 44 cents. It's a decent report, but with the possibility of decreasing profits and maintaining the dividend payout ratio, I would expect OCBC's this year's dividend to decrease slightly. At the current share price, it's giving about 5.7% dividend yield, assuming a 60% dividend payout ratio. Now let's go on to the last bank, and that is DBS. DBS Bank has been one of my favorite dividend stocks and has consistently been the outperformer out of the three banks. They have been the more aggressive and successful bank, which we will see from their results. Looking at their highlights, profit and net income is surprisingly up 1% and 5% respectively year-over-year, which is a big win because both OCBC and UOB experienced dropped. This is one of the reasons why their share price actually went up after the earnings. What makes it so unique is that their net interest income rose by 2% thanks to the strong deposit growth and balance sheet hedging. This was one of the reasons that I mentioned numerous times before that the DBS management has been amazing, as they had started hedging most of their loans a few quarters ago because they foresee the drop in the interest rates. Fees, treasury, marketing, trading income all rose. ROE dropped slightly but is still at a high of 17%. Their non-performing loans improved, showing the strong balance sheet with CET1 ratio still at a high of 17%. Rather than decreasing dividends, they have announced the same dividends of 75 cents this quarter. For quarter year-over-year results, it looks good with everything positive. One of the huge factors was thanks to the 100% growth in the market trading, and this shows how attractive DBS is to attract customers for managing their wealth. Thanks to the strong Q1 result, they continue to achieve record income for the first half of 2025. However, I will be more cautious as I feel that banks will start experiencing drop in their profit, including DBS, unless they can somehow execute exceptionally well in their non-interest income section. If we see their net interest income, unlike the other two banks, DBS Bank continues to have higher year-over-year interest income thanks to better market trading income. This is very important. Even though their net interest income margin dropped similar to the other two banks, their interest income did not change much. Why? It's because they hedged their loans early on and was able to offset with the growth of their deposits as well. Fee income continues to be strong for DBS with 14% year-over-year growth, while wealth management doing fantastic with 30% higher year-over-year. Like I previously mentioned, wealth management will be one of the important factors that will determine whether the banks continue to perform well or not, because their interest income will be expected to drop. Currently, DBS has the higher growth, followed by OCBC, and the most disappointing is UOB. Private banking for DBS has continued to perform well. As they build on their brands and offer to more accredited investors, I feel that it will continue to expand and do well for their wealth management section. For UOB and OCBC, they mentioned about the decrease in the profits from Hong Kong. However, for DBS, the interest income only dropped slightly by 1%, while fee income increased significantly by 25%. This is very impressive as their Hong Kong assets achieved 9% higher in net profit in a decreasing interest rate environment. Non-profit loans dropped from 1.1% to 1%, which shows the strong economy and the strong customers that they are loaning to. DBS has been paying a dividend payout ratio that is much higher than UOB and OCBC at around the range of 73%. However, their amazing results and high CET1 ratio shows that they can afford to do it. They still have plenty of cash with 17.3% of Tier 1 capitals available, which is much higher than the other two banks. One of the positive note is that the management actually forecasted higher net interest income despite lowering interest rate environment. Moreover, they expect to have double-digit growth in wealth management, which continues to show the strong gains that they should see. In conclusion, DBS continues to be the better performer out of the three banks thanks to the higher ROE percent and the improving efficiency of the bank. At the current share price, its dividend yield is about 5.8% and a dividend payout ratio of 74%. So if we look at the summary to compare between the three banks, DBS continues to be the standout performer with higher ROE as compared to the other two banks. However, DBS also has a higher dividend payout ratio of 74% compared to the other two banks of around 60% if we include bonus dividends for all three banks. Like I said, for DBS, their business is doing well with much higher CET1 ratio as well, to show the high amount of capitals that they have. Moreover, their net interest margin continues to be the standout at 2.55%, while OCBC and UOB has dropped significantly to 1.9%. However, DBS is also priced at a premium because their dividend yield is similar to UOB and OCBC, even though the dividend payout ratio is much higher than the other two banks. With interest rate dropping, I would expect the three banks' dividends to stop growing or even drop. It will be a big surprise if they can continue increasing their dividends. Like I said, wealth management will be one of the important factors, and DBS might have the potential to give higher dividends due to the strong growth in their wealth management to offset the drop in the interest income. At their current share prices, with bonus dividends, their dividend yields are in the range of 5.8 to 6% thanks to the drop in dividends while the share price have went up. They are still very attractive dividend stocks because they do not pay out 100% of their dividends and have a large amount of capitals available to either reward back shareholders or invest for their expansion in the businesses. With interest income in savings accounts dropping, people and investors that have lots of funds in these accounts will start looking for alternative solutions. Like they said, as the risk-free rates drop, the expected return in investments will also drop. Dividend yields of stocks will continue to drop. What this actually means is that the stock prices will actually increase because people would rather invest in a 6% dividend yield stock than living in a savings account which has the interest dropping from 4 to 2%. That is why even though some REITs might experience drop in their dividends as well, their share prices continue to rise or even maintain as their dividend yields will start looking to be more attractive. Thank you so much for watching. If you have enjoyed the video so far and find this informative, please support the channel by hitting the like, subscribe, or use my affiliate links below to start investing using the brokerage accounts. You can also share your thoughts on the bank's results, and you can watch my previous video analysis on why blue chip REITs like Mapletree are still facing drop in dividends. And if you are interested in my portfolio, you can also watch this video here. Thank you, and I'll see you in the next video.